Looking for new ways to grow your wealth? Join us as we delve into the world of real estate crowdfunding and P2P lending, where alternative investments are revolutionizing the way we invest, diversify portfolios, and achieve financial freedom. Since its inception in 2007, peer-to-peer P2P lending has disrupted traditional financial institutions by allowing borrowers to obtain loans at lower rates while offering investors higher returns than they would typically receive from government or corporate bonds. Despite the recent credit quality concerns and an increase in interest rates, a well-diversified portfolio of 100 or more AAA-rated notes can still yield historical returns of approximately 7%–8%. As the market continues to evolve, investors are seeking alternative investment options that offer similarly attractive returns. With credit quality concerns at the margin and a growing pool of investors competing for the same buyers, exploring alternative investment options has become a prudent move. In this post, we will dive into some of the top alternatives to P2P lending that offer attractive returns and diversification opportunities for investors looking to grow their portfolios. Real estate crowdfunding is a relatively new investment option that emerged in 2012 after the passage of the Jobs Act. This innovative platform allows individuals to invest in real estate projects either as equity or debt investors, with entry investments as low as $5,000, $10,000. By pooling their money together, investors can collectively purchase high-value assets that would have been otherwise unattainable due to the high costs associated with them. Historically, the returns for investors have been remarkable, ranging from 13% to 16%. Additionally, investors have the opportunity to diversify their investments across various regions of the country, particularly in the heartland of America, where valuations are lower and net rental yields are higher. With remote work opportunities becoming increasingly prevalent in the post-pandemic world, geo-arbitrage is more feasible than ever before, allowing investors to live in affordable areas and invest in properties all across the country. As the interest in real estate crowdfunding continues to grow, it has emerged as a viable alternative to P2P lending for investors seeking high yields and diversification. Alongside owning physical rental properties, real estate crowdfunding presents an opportunity for investors to participate in the property market and benefit from its potential returns without having to bear the full costs and management of owning a property. With the proliferation of real estate crowdfunding platforms in recent years, investors can be spoiled for choice. However, one platform has emerged as a clear leader in the industry: Fundrise. Founded in Washington, D.C. in 2012, Fundrise has established itself as a pioneer in the real estate crowdfunding space, catering to a broad market by creating airtight funds that are accessible to anyone with $500 to invest. In the rapidly evolving world of real estate crowdfunding, Fundrise is the oldest and most innovative platform today. Comment real estate if you like to see more videos on real estate. In terms of scale, Fundrise has amassed an impressive following of over 150,000 investors, with over $1 billion in assets under management as of 2022. This speaks volumes about the platform's credibility and reliability, making it an attractive option for investors seeking to diversify their portfolios with high-yield real estate investments. In this post, we will take a deep dive into Fundrise, exploring the platform's features, performance, and overall value proposition. In 2012, Fundrise was established to democratize real estate investing by allowing non-accredited investors to own a stake in commercial office space and multifamily condominium projects. The Miller brothers, inspired by their father's success as a real estate investor, raised over $200 million in capital from both accredited and non-accredited investors by 2021. As a pioneer in REITs, Fundrise offers diversified real estate funds and enables investors to participate in the lucrative real estate market with an average investment of $5,000. With annual returns ranging from 10% to 14%, investing in Fundrise is a smart way for non-accredited investors to diversify their portfolios with ease. As the CEO of Fundrise, Benjamin Miller brings 15 years of experience in real estate and finance to the table. During During his time as a managing partner at West Mill Capital Partners, he oversaw $500 million worth of property transactions. The company's chief operating officer, Brandon Jenkins, is responsible for overseeing the design and tech teams to ensure that the Fundrise software platform is functioning smoothly. Prior to joining Fundrise, he worked as an investment advisor and broker at Marcus & Millichap, the largest real estate investment brokerage firm in the United States. One of the most impressive aspects of Fundrise is the accessibility of its REITs, which are available to all investors, subject to availability. Each REIT, including West, Midland, East Coast, Growth, and Income, offers the opportunity for investors to benefit from the strategic and geographic decisions made by the REIT manager. Based on historical performance, investors have the potential to earn a healthy 8%, 16% return. Intriguing data reveals how real estate performance stacks up against that of the S&P 500. It's fascinating to observe the FTSE and AREIT all REITs asset class's remarkable outperformance, which may seem surprising at first glance. However, this phenomenon can be attributed to various factors, including the Fed's aggressive reduction of interest rates and the equity investors' inclination towards hard assets as a safe haven after the Nasdaq bubble burst in March 2000. As a result, real estate investments began to surge and subsequently delivered impressive returns. Fundrise prides itself on offering servicing fees that are among the lowest in the real estate crowdfunding industry at 30 basis points, 0.01% per year. However, investors should be aware that this fee may increase to up to 0.5% of invested capital per year, as specified in the platform's fine print. Each deal's annual returns are gross and not net of annual servicing fees. For all Fundrise REITs, investors do not have to pay asset management fees until they achieve a 15% annualized return. After this threshold is met or exceeded, asset management fees range from 1% to 1.5% depending on the specific REIT. For example, investing in Fundrise could result in a net return of 13.7% or $68,500, whereas a non-traded REIT may only yield a net return of 7.7% or $38,500. To learn more about Fundrise and its potential as an alternative to P2P lending, check out my latest post-pandemic overview. Data has consistently shown that investors who allocate 20% of their portfolios to real estate outperform those who only own stocks and bonds. This model was popularized by Yale Endowment, which has invested at least 20% of its portfolio in real estate and outperformed traditional allocations by 22.6% annually for decades. However, historically, the best private real estate opportunities have required high minimum investments of $100,000 or more, making them inaccessible to most people. The other option was to use intermediaries who charge high fees, reducing potential returns. This is where Fundrise's technology comes in, offering investment minimums as low as $500, making private real estate investments more accessible to a wider range of investors. Thank you for taking the time to watch this content. We hope you found it informative and enjoyable. If you like this content, please don't forget to hit the like button, leave a comment with your thoughts or questions, subscribe to our channel, and share it with your friends and family. Your support helps us to continue creating high-quality content that informs, educates, and entertains our audience. We appreciate your feedback and suggestions, and we're always looking for ways to improve our content to better serve our audience. Thank you again for your support, and we look forward to bringing you more great videos in the future.